Please come to functions of stock exchange. This was covered in the previous chapters also in the secondary market topic. Okay. So what is a stock exchange? It is a place where securities are bought and sold. It's a secondary market. It provides an exit route to the investor. So those who have purchased their securities in the primary market, they can sell in the secondary market. Or those who want to buy and sell can do the trading in the secondary market, that is the stock exchange. In stock exchange, shares, debentures, bonds, derivatives are traded. So it is a place where wealth can be created. If you purchase the share and if the price goes up, wealth will be created. But at the same time, if you purchase the share and if the price falls, wealth can be destroyed. Stock exchange provides liquidity, and that is why it helps in overall growth of the economy. It helps in capital formation. It converts idle savings into productive investments. So now we will see some of the major functions of stock exchanges. Liquidity and marketability of security. So suppose they write a case study. One Mr. X is scared of stock exchange. He does not know anything about stock exchange. As a financial consultant, explain him the function of stock exchange and motivate him to invest in the stock exchange. Then write this paragraph. Okay. That means same answer can be converted in the case study, or they can give you true, false, etc. Fill in the blanks, MCQ from this paragraph. So first is, does stock market provide liquidity? Yes. Does it provide marketability? Yes. Okay. So the basic function of the stock market is the creation of continuous market for security. In the trading hours 9 to 3:30, you can buy and sell any security, and therefore it is highly liquid place where investor can convert their security into cash at any time at the prevailing market price. It also provides investor the opportunity to change their portfolio as and when they want to change. So after the election, if you think share price will fall, you can sell it and change your portfolio. You can move your portfolio from one security to other security. That is, they can sell at any time one security and purchase another, thus giving them marketability. Share market is also beneficial because lakhs of people are buying and selling the shares every day. When lakhs and millions of people are buying and selling the share on a daily basis, it provides a fair price. Prices cannot be manipulated. There is no monopoly of a single buyer or a single seller. Okay. So therefore there is a line which says it is like a perfect competition market. It is like a perfect competition market because there are large number of buyers and sellers, and due to nearly perfect information, active bidding takes place from both the sides. Investors are also smart like you nowadays, so they know what should be the price of this share, what is the worth of this share, and accordingly they give the quotation. The buyer says I want to buy at this price, the seller says I want to sell at this price, and because of the demand and supply forces, the prices are fairly determined. Is stock market a source for long-term fund? You will say it is just a secondary market. How is it a source for long-term fund? Because stock market is there, companies are able to issue equity shares, which is a long-term source of finance. Companies are able to issue debenture, which is a source of long-term finance. Had stock market not been there, can the company issue equity share, raise so much of funds? The answer is no. People invest in primary market because they know that this security will be available for trading in the secondary market. So corporates, government, public bodies are able to raise funds from the equity market. And in the stock market, these securities can be transferred to other investors. They are traded and change hands from one investor to another investor without affecting the long term availability of the funds to the issuing company. Even though trading is taking place in the stock market, does company get affected? Company will keep that funds for long term. If it is a redeemable instrument, it will be redeemed only on maturity. And if it is instrument like equity share, the funds will remain with the company for a long period. Capital market helps in, or stock market helps in capital formation, wealth creation. Idle savings are converted into productive investment. Okay, you are article, you have lot of money earned during articleship period. Okay, say you have earned 5 lakh rupees, and if you invest in the security market, this money which was lying idle in your current or saving account, say saving account, now it goes to corporates, and the corporates invest in productive areas. They construct factories, they buy plant and machine, infrastructure, software development. So it converts your idle savings into productive investment. So that is how stock market helps in capital formation. The savings of the community are mobilized and channeled by stock exchange for investment into those sectors and units which are favored by the community at large. On the basis of such criteria as good return, he also benefits, he gets return on his investment much more than what he will get in a saving account, appreciation of capital, and so on. It is the preference of investor for individual units as well as industry group, which is reflected in the share price that decides the mode of investment. Investor has a wide choice here in stock market. He can choose the company he wants to invest, he can choose the industry that he wants to invest. If you think that in the next few years pharma company is going to do well, you can choose pharma company. If you think that automobile company is going to do well, you can invest in automobile companies. So stock exchanges render this service by arranging for the preliminary distribution of new issue of capital offered through prospected as also offer for sale of existing security in an orderly and systematic. Prospectus is issued for new security. Offer for sale is for, I have told you, right shares. Okay. And in this prospectus or offer for sale, all information that you need to take decisions are given. Everything is systematized. Okay. There is a process designed for everything in the stock market. So normally it will not go wrong. Next point in capital formation, they themselves administer the same by ensuring that the various requisites of listing means now they will explain that all processes are duly followed. What are the various requisites of listing, such as offering at least the prescribed minimum percentage of capital to the public? Stock market will see that minimum 25% shares are with the public. If not, delist. Keep the subscription list open for a minimum period of days, which is usually 3 days, so that the investor can take informed decision, making provision for receiving application at least at the prescribed centers. So you have to have centers where investors can submit the application, allotting the shares against application on a fair and unconditional basis are duly complied with. So stock exchange will ensure that all these conditions are satisfied, all rules are followed. Members of the stock exchange also assist in the flotation of new issues. Members means those who take the membership of stock exchange, brokers. They also help the client. How do this member help the client as brokers? In which capacity? Inter alia, they try to procure subscription from investors across all over the country. That means they will inform their client, brokers will inform their client How do you think so much of people invest in the stock market? How do they know? It's through the broker network. Yes or no? Every city has 100, 200 brokers. Each of them have 100, 200 clients. So this way, through this broker network, all investors get to know about the public issue, right share. And these brokers also try to convince them whether they should invest or not. Then these intermediaries also act as underwriter. So it gives confidence to the company. If public does not subscribe, we will subscribe. Next point, stock exchange also provides a forum for trading in right shares of companies already listed. Even the right shares are traded. Right shares are no different from other shares. Only at the time of issue there is a priority given to existing shareholder, thereby enabling a new class of investors to take up a part of the rights in place of existing shareholder who renounce their rights for monetary consideration. So even new investors can join the company, subject to the existing investors renounce the rights in their favor. The performance of the stock market reflects the boom and depression in the economy. So if the stock exchange index, this is Sensex, going up, it means overall there is a boom. Share price is rising. It means earnings of companies are rising. Overall growth. But if suppose the share market is falling continuously, it shows the depression in the economy also. However, many people believe that you just can't look at the stock market's index and predict about the economy as a whole, because stock market index is just based on 30 shares or 50 shares. Second, only few companies are listed on the stock exchange. Indian economy has around 20-25% people dependent on agriculture. How can you link the performance of agriculture with the stock market index? So this is like a general statement, but a debatable statement whether stock market performance reflects the general state of economy. You will write yes, okay. After passing, like me, you can debate. It indicates the general state of economy to all those concerned who can take suitable steps in time. The government takes suitable monetary and fiscal steps depending upon the state of economy. Many times the government also keeps a watch on stock market, and according to stock market movement, the policies decisions are also revised if required. Okay, because if the market continuously falls, government has to do something. Otherwise, people confidence in the capital market, secondary market, primary market will not be there. Raising of funds will become difficult. So even government continuously monitors the stock market, and if required, they change their policies also. Okay. Now, the next part of this wonderful chapter, which you have learnt in group 1 also, is Indian commodity exchanges. Is it there, Indian commodity exchange? Yes. Indian commodity exchanges we'll discuss, and we'll solve few questions also, so that you'll not go into sleep mode. And good news, next chapter number 7 is also commodity exchanges. So 90% of what we are going to cover here, almost 90, will again come in chapter number 7. So today I will try to go in detail only, and chapter number 7, the common points we will go little fast, okay? Because that chapter is also commodity. Some question I will take here, some questions I will take there. Whatever formula I will give you today will be applicable tomorrow also. Ready? Which exchange has more trading? Stock exchange or commodity exchange? Commodity exchange. I was doing some research on commodity exchange in India, and then one line attracted my attention. In MCX, Multi Commodity Exchange of India, on a single day, some year back, in one single day, the volume of transaction was 1 lakh crore. Huh? It is 1 lakh crore on a single day, not in a year. And then I thought, what is their average? The average is around say 15 to 20,000 crore rupees now on a daily basis, which is of course more than the stock market. That maximum derivatives are traded in the commodity exchanges because people understand commodities better than index, stocks, etc. Okay, like Indians understand gold better than anything else, even though it is the most non-productive asset. 1 kg of gold after 5 years also remain 1 kg only. It doesn't give you any interest, dividend, rent, increase in the size, value, or volume. Okay, but still we are obsessed with gold. India is a gold obsessed nation, which is a non-productive asset. Land at least gives you rent, or you can produce some fruits, vegetable. What will you do with 1 kg gold? It remains 1 kg only. And then agricultural products are also traded in the stock exchange. So we will see some of the key Indian commodity exchanges. Okay. So which are the four main national level commodity exchange in India? Actually, there are many, but these are the main ones. National Multi Commodity Exchange of India. Commodity market is very important because it helps in price discovery for commodity. It helps in identifying what would be the price of commodity in the coming months. Okay. It provides a place where you can transfer your risk. If you're a farmer, you can transfer your risk through commodity market. If you're a producer, you can transfer your risk through commodity market. And of course, if you are interested in speculation, this is a very nice place we can speculate and make profit. This also provides opportunity for arbitrage. So all benefits of derivatives are available here. So which are the four national level commodity exchange? NMCE, ICEX, Indian Commodity Exchange. Then National Commodity and Derivative Exchange, NCDEX. And the most important out of this is MCX, Multi Commodity Exchange. In the next few paragraphs, they have discussed the features, function, some facts and figures about these commodity exchanges. So just we'll go through it fast. It's an open book exam. Anytime you can come and check the facts. Okay. Only remember it is in chapter number 6 and 7. Commodity exchange. So any fact based question you can refer here. National Commodity and Derivative Exchange Limited, in short NCDEX. Most of them are having same function, same business model. Only the year when they were formed were different. The promoters may be different. Okay, maybe in some cases the headquarters is also located at a different place. Otherwise, the basic functions are same. So it is professionally managed online multi commodity exchange. That means you can do trading online. And it was promoted by some of the big names in the finance sector like ICICI Bank, LIC, NABARD, NSC, PNB also. CRISIL Limited, formerly known as CRISIL, is formerly known as Credit Rating Information Services of India Limited. It's a credit rating company. Credit rating is another chapter in our syllabus. Then IFCO. What is IFCO? Indian Farmer Fertilizer Cooperative Limited. Then Canara Bank and Goldman Sachs. Goldman Sachs is an investment company, merchant banking company. By subscribing to the equity shares, so these are the promoters, have joined the initial promoters as shareholders of the exchange. If you look at this name, these are some of the big names in the Indian capital market. NCDX is the only commodity exchange in the country promoted by national level institutions like ICICI Bank, LIC, NABARD, NSC. These are all national level institutions. NCDX is a public limited company. So, what is the legal structure? Public limited company. When was it incorporated? 23rd April 2003 under Companies Act, that time 1956. And it started operations from which month and which year? 15 December 2003. It is a national level, technology driven, demutualized, online commodity exchange. So many features, national level, throughout the country, anywhere you can use this NCDX, and it is highly techno driven. Demutualized means it is in the form of a corporate. It is formed as a company only with an independent board of directors and professionals not having any vested interest in the commodity market. So they try to ensure no conflict of interest. Only such people will be appointed in the board which have no interest in the commodity market. Otherwise, manipulation is possible, fraud is possible, scam is possible. It is a it is committed to provide world class commodity exchange platform for market participants to trade in a wide spectrum of commodity derivative and driven by best global practices, professionalism and transfer. Is our institute talking like a brand ambassador? All अच्छी अच्छी बात, हाँ ऑफ कोर्स, दैट इज भाई ब्रांड एम्बेसडर, टेक्नोलॉजी ड्रिवन, नेशनल, ये वो, professionalism, transparency. Okay, as if they are asking you to come and invest and trade here, open an account. Initially, it was regulated by Forward Market Commission. Underline. Now, I need to tell you this. Till few years back, who was the regulator? Forward Market Commission, FMC. But then FMC has been merged with SEBI now. So even the commodity market is now regulated by SEBI from 2015 onwards. So SEBI is the regulator of commodity exchange. This is a potential question for MCQ. Student may write Government of India, FMC. FMC was there. RBI is not there at all. NCDX is also subject to various laws of the land. What are the other laws they will have to follow? Because it's a company, follow Companies Act, Stamp Act, Contract Act, SEBI Act, and various other legislation which impinge on its working. Not only its working, in India there are so many laws which impinge on the working of any businessman. Is it right? Today one small trader called me and said, "Sir, this GST is very bad." I said, "Why? So many compliance. Should I do business or just keep complying with this uh, input, output, invoice, challan, e-way, highway?" I said, "There is one trick. How many members you have in the family?" He said, "Seven." I said, "You open seven forms and record up to less than 20 lakh under each form, okay? No GST, no complication." This is what businessmen do. He said, "Sir, I'm already doing that. But still my turnover has now crossed that limit." Then I said, "You hire some CA. Our community will also get some income." MCX. Even the commodity exchanges have to face several laws because here public money is invested. Okay, they can lose lakhs and crores of rupees on a single day, and therefore lot of control is there on the stock exchange and this commodity exchanges. So that was just an example. Multi commodity exchange of India is the biggest out of this lot. It's an independent demutualized multi commodity exchange. It has permanent recognition from Government of India for facilitating online trading, clearing and settlement operations for commodity future market across the country. Is it right? In how many cities they have their operations? 1770 cities and towns across India. My God. We don't have so many virtual centers and these have got so many offices. Okay. MCX offers a wide spectrum of opportunities to large cross section of participants. So who can come and trade in MCX? Anybody. Like for example, it's a very good platform for producers and processors. You're a farmer. You're putting a lot of hard work. You're growing crop. After 4 months, when the crop will be ready, prices can crash because there is a bumper production. So even though you have put a lot of efforts, time, money, you'll not be able to recover the cost also. So what you should do? You should sell in the commodity market. You can take a 4 month future, 3 month future, whatever is available. Lock the price. Is it right? Or suppose you are a bread manufacturer. You need wheat. Price of wheat can rise and it will increase your cost of production, will result into loss. You can purchase wheat in the future market. Okay. So businessmen who have to sell in future time period or purchase in future time period, they can use the commodity exchange. Traders can use it. Okay. Corporates can use it. Regional trading center, importer, exporter, cooperatives, industry association amongst others. Student can also for speculation purpose. Okay. It offers trading in more than 30 commodity future contracts. Now this number is grossly underestimated. Huh? It is more than 100. Make it more than 100, but you check on the website of MCX. Last time I had checked, it was more than 100. 30 is very less. 130. I think it should be 130. Huh? Possibly. It is around 130. You're right. Their headquartered is Mumbai. MCX is led by an expert management team with deep domain knowledge of the commodity future market. Of course, the management has to know what they are doing. And it is a nationwide commodity exchange. It is the most popular commodity exchange, in fact. And it has a state of art infrastructure offering multiple commodities for trading with wide reach and penetration. MCX is well placed to tap the vast potential posed by the commodity market. So they're trying to benefit from this commodity market as much as they can because they know that Indians are big time speculators. Right from Mahabharata, even Yudhishthir cannot stop himself from gambling. Okay, one of the wisest man in that Pandava group, he also used to gamble. So much that even he put his wife at stake and lost also. Okay, we are descendant of such people only. So that is why the last sentence. It wants to harness the potential of commodity market means come gamble more and more. Now, who are the key shareholders of MCX? Financial Technologies was the promoter, but now the name of this FTI Limited Financial Technology is changed to 63 Moons Technology Limited. Okay, I will not tell you the reason because there was a lot of scams earlier in which this company was involved, or at least alleged that it was involved. Change the name. Okay, then State Bank of India and its associate, NABARD, NSC. Then there is a Mauritius based company also, Fid Fund Mauritius Limited, an affiliate of Fidelity International, Corporation Bank, Union Bank, Canara Bank, Bank of India, Bob, Bank of Baroda, HDFC Bank, SBI Life Insurance Company Limited. My God, all big shots are there as shareholder of this MCX. More about MCX in the next chapter. Next is Indian Commodity Exchange. This is another commodity exchange, Indian Commodity Exchange. In short, we will call it ICEX. And it is also similar to the others only. Nothing extraordinary about it. It is a screen based, everybody is now screen based, online derivative exchange for commodities. It has a robust assaying and warehousing facility in order to facilitate delivery. Then you can ask this question, what is the meaning of assaying facility? So write down the meaning of assaying facility. So the dictionary meaning of assaying is qualitative or qualitative or quantitative analysis of a substance. Qualitative or quantitative analysis of a substance. Qualitative or quantitative analysis of a substance. Now I need to explain what is the relevance of this word assaying here in this line. Suppose you have to trade in gold. There is no one single variety of gold. There are different grades of gold. 18 carat, then 22 or 24, something like that. So they have got the specialization in that. Another example, wheat. Are all wheat same? Wheats have grades. Okay, so that means it's very important that when you are dealing in trading in commodity market, you should know which grade you are buying or selling, because the prices are different for different grades of product. So they have got this specialization in grading the commodities according to certain parameters, so that trading becomes easier. The buyer and the seller knows exactly which grade they are buying or selling. And they have a warehousing facility also, so that in somebody wants delivery based settlement, then it can be done. Okay, then it has Reliance Exchange Next Limited as anchor investor. So who has provided the funds at the beginning? Reliance Exchange Next Limited. This anchor investor also we'll discuss in another chapter. All different types of investor: anchor investor, private equity investor, venture capitalist, seed capital. Okay, so this will also be covered in this part of your syllabus. Very interesting subject. You've taken a right decision. And the other shareholders are MMTC. What is MMTC? Mineral Metal Trading Corporation. Okay, this is a, to my knowledge, Government of India enterprise, Mineral and Metal Trading Corporation. Then India Bulls Financial Services, Indian Potash Limited, Crevco, and IDFC, among others, as its partners or stakeholders. This Crevco is also some Krishi something, okay, related to agriculture. But I don't know full form right now, don't bother. Where is the head office located? Mumbai. and has regional offices spread across the country, which covers agri belt with a vision to encourage participation of farmer. So that is something it's at least extra in this. One was they have this grading and warehousing facility, and secondly they are trying to bring more and more participation of farmers, traders, and actual users to hedge their position against the wide price fluctuation. If you are a producer, consumer of agri products, metal products, and if you are scared that prices may change, commodity market is a good place where you can hedge your price risk. So originally the idea of creating derivative product was hedging only. We have converted into a speculation based market now. 95 to 98% of the trading is only for speculation. Do you know that? Only some 3-4% are genuine hedging transactions in commodity market. It provides the widest range of benchmark future products available on any exchange, covering all major commodities. So like other exchanges, this also gives you a wide options, number of commodities which you can trade in. It offers future trading in agricultural products, bullions, means silver and gold. Bullion means silver and gold. Then base metals and energy, oil. So in most of the commodity exchange, the commodities are divided into these 4 or 5 groups basically: agri products, bullions, base metal, energy. Okay, this is the broad classification. Then under agriculture, you will have rice, wheat, whatever they want to trade. Then next is NMCE, point number D, Multinational Multi Commodity Exchange of India. It is the first demutualized electronic multi commodity exchange of India, being granted the national status on a permanent basis by the government of India. So one feature, it is first uh, demutualized exchange, and then it was recognized by government of India, and it has become operational in 26 November 2002. It is promoted by commodity relevant public institution. So who are the promoters? CWC, Central Warehousing Corporation; NAFED, National Agricultural Cooperative Marketing Federation of India; then GAICL, Gujarat Agro Industries Corporation Limited; GSAMB, Gujarat State Agriculture Marketing Board; then NIAM, National Institute of Agricultural. So all these are related to agriculture, and Neptune Overseas Limited and Punjab National Bank. So promoters. Next is NMC is unique in many other respects. So what are the other important aspect of this company? It's a zero debt company. Wow, zero debt company like ES Foundation. Okay, and following widely accepted prudent accounting and auditing practices. Again, it has robust delivery mechanism, making it the most suitable for participation in physical commodity market. This is almost common now in every exchange. Exchange does not compromise on its delivery provisions to attract speculative volume. So they follow the ethical principles. Okay, public interest rather than commercial interest guide the functioning of the exchange. It seems the institute must have copied from their promotional literature all these paragraphs and they must have pasted. Okay, is it right? Because the way these sentences are drafted, it is clearly a promotional literature rather than ICI material. Just like politician says, my job will be public interest, not my personal interest. Okay, continue. Next 4 points. It has also established fair and transparent rule based procedure and demonstrated total commitment towards eliminating any conflict of interest. It is the only commodity exchange in the world. Underline. The source of this information is ICI material. I have to verify it. Okay. It is the only commodity exchange in the world to have received ISO 9001 2000 certification from British Standard Institution. I doubt this line only commodity exchange, but it's okay. The onset of these exchanges and the introduction of future contracts on new commodities by the forward market commissions have triggered significant levels of trade. So, in general, the trading in commodity exchanges have increased. In general, I was doing some studies on commodity exchange and I found that the volume in this market has been increasing every year by thousands and thousands of crores of rupees. Like if it was 7,000 crore rupees some year back, that exchange has 15,000 crore rupees every day trading, every day. On certain seasons, as I told you, in case of MCX, it was more than 1 lakh crore. And that is like was written there, it was like a world record in a commodity exchange to have 1 lakh crore rupees volume on a single day. You can check MCX website, it is mentioned there. Now the commodity future trading in India is all set to match the volume on the capital market. So that gambling instinct they are fully capitalizing. Okay. Next is international commodity exchange. First you write referred chapter 1 because in chapter 1 also we had international commodity exchanges. One more good news. In chapter 7 also coming soon. After this, again you will have to study the same. So major international commodity exchanges are discussed as follows. Exactly same thing they have copied and pasted from chapter number 1. Chicago Mercantile Exchange, CME. So I will go through it fast because we have covered this in chapter 1. There is nothing additional information they have added. It is a financial and commodity derivative trading platform which was headquartered in Chicago. It was established in 1898 and what was its original name? Chicago Butter and Egg Board. Presently, Chicago offers contract of all kinds, which includes agriculture, credit, equity index, interest rate, and other future and option investment. That's it. Next is CBOT. CBOT means Chicago Board of Trade, formed in 1848 and being considered amongst oldest future or option trading exchange in the world. So it is one of the oldest future and option trading exchange because it was formed in 1848. So remember 1848 and they started future and option trading. The exchange offers more than 50 different future and option contract for investor, which scattered over a number of asset classes. The NYMEX, New York Mercantile Exchange, NYMEX, New York Mercantile Exchange, is the world's largest physical commodity future exchange, which offers a wide variety of products. Then COMEX, what is the full form? Commodity Exchange Inc., which acts as the division of NYMEX, also offers exposure to various metal contracts. So they have specialization in metal contracts. Then you have a special entity, London Metal Exchange, formed in 1877. However, it has roots in 1571 when the Royal Exchange in London was founded, trading only copper at that time. It's a major exchange which offers exposure to future and option of various varieties of base metal and other commodity products. Some of the metals which are traded are aluminium, copper, tin, nickel, zinc, lead. Okay, which is the next one? Intercontinental Exchange in ICE. Where this we had seen earlier also in some chapter. Intercontinental Exchange. First chapter, and I think in the fifth chapter also. ICE LIBOR. That time also the ICE word had come. The Intercontinental Exchange is an American company which operates future and over the counter contract through internet. In the beginning, the company was operating energy contracts but has increased its scope by offering exposure to a number of commodities. So, from energy contracts, now this exchange is trading in cocoa, cotton, sugar, iron ore, natural gas, and crude products. Okay, this was mentioned in your ICI study material. Next few pages I have contributed to this chapter. Okay, next 3 pages my contribution to this chapter, not from your ICI material. Which are the important commodities traded in the commodity exchange? So broadly, there are few classification like agricultural, base metal, bullion, okay, energy. And then if you want to learn some more, it's like precious metals like gold and silver, non-ferrous metals, cereals and pulses, cotton, oil seed, oils and oil cakes, raw jute and jute goods, sugar, potatoes and onion, coffee and tea, rubber and spices. In your book, I have added some more crude, chana, guar seed, mentha oil, and like this, there are about 100 plus commodities now. Not everything is traded. You can't buy railway ticket in commodity exchange. Okay, you can't buy movie ticket in commodity exchange. Only sometime, some products, some commodities. Here's foundation pen drive. Not right now, but future possibility cannot be denied. Come to the topic, don't disturb. Who are the main participants in the commodity market? These participants can be divided into three types. As you know, in any derivative market, hedger, speculator, arbitrageurs. Hedgers means those who have to protect themselves from price risk, like farmers. A farmer is growing wheat, he thinks that the price may fall due to bumper production. He can sell wheat in the future market. If the price falls, still he will be able to receive the predetermined price. Okay. A manufacturer wants wheat after 4 months, but he is worried that wheat price may rise. So he can buy wheat in the future market. And if the wheat prices actually rise, he will be able to procure wheat at the predetermined price. That is called hedger. And then who are the arbitrageurs? They try to exploit the mispricing between the cash and the future market. There is a mathematical relationship between spot market and future market. Okay, if suppose sugar trades at 20 rupees per kg in the spot market, interest and storage cost is 3 rupees for 3 months, then mathematically in the future market sugar should trade for 23, but sometime it may trade for 25 rupees. If this happens, arbitrage opportunity will arise, and people like you, the people, will buy sugar in the spot market at 20, sell in the future market at 25, and after 3 months he will make a profit of 2 rupees because he has 1 kg of sugar also to deliver. So he will sell the sugar in the market, or he will sell the sugar and collect 25 rupees as per the contract. Okay, so 2 rupees profit can be earned, but it's not as simple as it looks on the example. If so much arbitrage opportunities available, more and more people will do this activity. Why will you come to the class and study this capital market subject, indirect tax subject? You will do the sugar trading only. That is more beneficial. So demand for sugar will rise, supply of sugar will rise. This 20 will become 21, 25 will become 24, total will again become 24. So it is temporarily available. And arbitrageurs, it requires again a lot of specialization, expertise. Okay, you should be able to borrow money quickly. You should have money to immediately buy or sell the uh, underlying items. You can take the benefit, but the market is flooded with this type of participant. The speculator, he is willing to take risk in the hope of making profit. He thinks that gold price will rise after 3 months because in India gold price rises during festivals. So why not to take a position? If his expectation turn out to be true, he'll make profit. But his expectations go wrong, loss. Okay. Now everything is possible in this market. Dear student, before you enter the market, be careful. Okay. Who are the regulators of commodity markets? So there are three tier of regulation. One is the government of India, and just write down below ultimate regulating authority, boss of the bosses. Okay, they can do anything. There are cases where overnight they have stopped trading of certain commodities by passing an ordinance. Yes, I remember some years ago, onion was traded on the commodity exchange. But then the onion prices started going up. Huh? Even salt. So that is I am telling you. And then people use commodity market for making profit in such commodities. The government banned the trading only by passing an ordinance that this item you can't trade in the commodity exchange because it will give rise to more and more speculation also. Then, as I said, now SEBI is the regulator. Earlier, FMC was the regulator, and then commodity exchanges have their own rules and regulations, like stock exchanges have, for regulating trading on a day-to-day basis. That is, those who want to trade in the commodity exchange, please follow my rule. This is my territory. Market will open at 10 a.m. You can't knock the door at 5 o'clock in the morning. Market will close at 11:30 in the evening. These are the commodities available for trading. This is the margin you have to pay. On this item, delivery is available. On these commodities, deliveries are not available. Okay. So this is the regulation. One more paragraph I have added in this chapter, which was not there in the original material. Which commodities are suitable for trading? Which commodities are suitable for trading in the future commodity market? We are talking about future now. Have you heard future? Future is a contract to buy or sell a specific quantity of a specific commodity at a specific price on a specific day. Okay. Contract to buy or sell specific quantity, specific commodity, specific price on a specific day. in future. So you will negotiate the price, the quantity, the commodity, quality. If it is a commodity, then grades also. Execution will take place at a future date. So which commodities will be available for trading in the commodity market? So they look at the following features of a commodity and then they list it for trading purpose. Like the market for the commodity should be competitive. What is competitive? Second line. There should be large demand and supply of the commodity. That means it should be such a commodity that there are large number of buyers for that, large number of sellers for that. Demand and supply is very high. Then no individual or group of persons acting in concert should be in a position to influence the demand or supply and consequently the price substantially. That means the market, there should not be a single person or a group of person who can influence the price. Otherwise, they will manipulate the price. There should be fluctuation in the price. This is derivative market. The whole game lies in fluctuation. If there is no fluctuation, will derivative market exist? No. Then why do you need a derivative market? As a hedger, speculator or arbitrager, you don't need a derivative market if there is no fluctuation in the price. The market for commodity should be free from substantial government control. Okay? Because if government decide the price, again, derivative market will not function efficiently. And the commodity should be capable of standardization and gradation. That means you should be able to understand which commodity you are actually buying. Like we discussed gold, there are different grades. Wheat, there may be different grades. Okay. So for commodities, the quality grades are different. So you should be capable of standardization and gradation. Now to make this chapter little more interesting, for a few minutes we will solve two questions. Okay. You may have studied in SFM, you may not have studied, up to you. How are future prices determined? How are future price determined? That means what should be that future price which will not give rise to arbitrage opportunity. So this is the mathematical connect. This is the mathematical connect between spot and future price. This is the mathematical relationship between spot and future price. That means future price should be equal to this. And if not, what will happen? Arbitrage opportunity will arise. Okay. So what is the formula? The formula is future is equal to S. What is S? Spot price. That is the current market price of the commodity. Plus I. What is I? I is the present value of storage cost of the commodity over the period of the forward contract. Because if it is a commodity, it will require storage. Like I said, if 20 rupees you can buy sugar, but if you have to store it for 3 months, for 3 months there is 3 rupees storage cost. So in case of commodities, we have to incur storage cost. Okay. And the storage cost, if it is given after a few months, then you have to convert into present value, so that both the figures are in present value terms. Suppose storage cost is paid in advance, it's already in present value. But it's possible you store in a warehouse, but they charge you after 2 months. Then take present value of that. Derivatives are valued using continuous compounding. Derivatives are valued using continuous compounding because there are large number of factors which affect the value of a derivative which operate continuously. There is a continuous impact on the value of derivative. So hence we will follow continuous compounding unless otherwise specified in the question. Unless otherwise specified in the question, because question have specified in the exam monthly compounding, quarterly compounding, then you follow that. If the question is silent, we will follow continuous compounding. What is E? E is a mathematical constant whose value is 2.7183. So we will use this much digits only, 2.7183. In all the problems, there are two problems below. What is R? R is the risk-free rate of interest to be compounded continuously. And what is T? T is the time until delivery of the forward contract in years. If interest rate is given per annum, then if time is given 3 months, you have to take 3 by 12. If time is given in days, divide by 365. Okay. So maintain consistency between R and T. If R is given 1% per month and time is 3 months, then I take 3 directly. Don't again divide by 12 time. Sometimes in this chapter, you may be given storage cost, not in rupees term, but as a percentage of the spot price. But as a percentage of the spot price. Is it right? So when the storage cost is given in rupees, apply this formula, first formula. When the storage cost is given in percentage of the spot price, then in that case, my formula will be S into E to the power R plus I into T. One student is asking why plus, why not minus? There are two costs. R is your opportunity cost and I is your storage cost. So I am adding my cost. Here also, I am buying sugar for 20 and I am paying 3 rupees for storage. So my total outflow will be 23. So plus. In derivative, when you are valuing the items like stocks, shares, that time the stock gives dividend. So that is my inflow. So in that case, what we do in case of items like stock, we deduct the present value of income from the spot price, because there are two different cash flows. Buying a stock outflow, dividend is inflow. So we take the net. But here my both cash flows are outflows. The commodity I am buying, I have to pay. Storage cost I have to pay. So that is why the plus sign is there. Okay, and this is just your total cost becomes R plus I. If any other cash flow is also given in the problem, like for example, in case of commodity, you may get a cash rebate. The nature of the commodity may be such that the supplier may provide you cash rebate. Then in that case, that cash rebate will also be adjusted in our formula as follows: spot price plus PV of storage cost as usual, and cash rebate in present value terms will be deducted. Now why minus sign here? Inflow. We are receiving that. Okay. Into e to the power RT. Then you will ask, what if cash rebate is also given in percentage? Use minus sign here. R minus whatever rebate percentage. Okay. So whenever this storage cost or rebate is given in rupees, convert into present value, adjust in the spot price. Whenever the storage cost or rebate is given in percentage of the spot price, adjust in R. Storage cost add, rebate deduct. Now we will solve. Question number 1 printed just below that. And I have seen in your study module also, there are some questions. Study module, chapter number 7 I saw. Then in model test papers also there are few questions. So therefore we need to have some revision of numerical questions on this topic. Question number 1. AS Foundation Limited has the following information about LD LDPE and HDPE granules. What is LDPE and HDPE granule? These are the raw material used for manufacturing plastic films, polyfilms, and plastic sheets. Okay. Are we really interested in this extra knowledge? No. Come to the table. Two columns for these two types of raw material. Current market price, that is spot price, that is S0, 75 rupees per kg, 85 rupees per kg. Carrying cost is 4% per annum, continuous compounding. And here it is rupees 100 per quintal per quarter, payable after 2 months. That means for one quarter, means 3 months, 100 rupees per quintal, but you have to make the payment after 2 months. So what is the difference in the two question? Here the storage cost is expressed in percentage. Here the storage cost is expressed in rupees. And then in the actual market, 3-month future contract is trading at 39,000 rupees for LDP and 44,500 for SDP, and the lot size is 500 kg. What is this 500 kg? Lot size. Okay. So the question is, if the interest rate is 12% per annum, advise ASF Limited on the course of action to be taken. What is the meaning of course of action to be taken? Whether they should enter into a buy future contract or sell future contract. So first we will compute the theoretical future price, means equilibrium future price, means fair future price. What should be the value of the future contract based on spot price, carrying cost, interest rate and time? Compare that with the actual quote in the market. Check whether it is overvalued or undervalued. Overvalued, sell. Undervalued, buy. Okay. So dear students, solve. First I will solve case 1, LDPE granules. Low density polyethynyl granule. To my knowledge, this is called low density polyethylene. But we are not actually interested. We are CAs. We are interested in numbers. Solve. I hope you remember the formula. I have just now dictated the formula above. First write down theoretical forward price per kg. Formula is printed above. S into e to the power r plus I into t. Because for this commodity, the storage cost is given in percentage. So I will write the numbers and then you have to solve. 75 into 2.7183 to the power 0.12. 0.12 is the interest rate plus 4%, that is your carrying cost, into time 3 by 12. Solve yourself. Write up to 2 digits after the decimal in your final answer. Yes, come on. Huh? 38. For 500. Right now it is coming to 78.061. Just check. How do you solve this? I hope you know. 0.16 into 3 by 12 is how much? 0.04. And can you solve 0.04 power? How do you solve? 2.7184 to the power 0.04. How to solve this? First you take square root of that whatever number is printed here, the base number, 2.7184 12 times. After that you just type -1. Then after that you type multiply by the power. Whatever is the power you write multiply 0.04, and then step 4 you press plus 1, and step 5 you press multiply equal to 12 times, multiply equal to, multiply equal to this. Okay, solve. So you'll get around 78.061 for 1 kg. Lot size is 500 kg. Lot size is 500 kgs. So now those who have completed will write step 2. Forward theoretical forward price per lot of 500 kgs. Theoretical forward price per lot of 500 kgs. So 500 into 78.061. 500 into 78.061, that is 39030. You can write point also if you want, no problem. But for decision making, this is enough. Yes or no? Step 3, write actual 3-month future contract rate. Actual 3-month future contract rate equal to rupees 39,000. This is the rate at which future is trading. You can buy and sell at this rate. Now you compare the two. It should be 39,030. Available at 39,000. So is it overvalued or undervalued? Undervalued. Should be 39,030. This is the range. It is available at 39,000. So evaluation, right? Step number 4. Evaluation. Future is undervalued. Future is undervalued. And then step number 5. Recommendation. If you want to make arbitrage profit, then you should create the strategy in such a manner that on maturity you should not suffer the loss. So buy future. Only buy future will result into loss if the price falls. Sell spot. Sell spot. Okay. So this strategy will give you certainly a profit of 30 rupees per lot. The difference between these two becomes your arbitrage profit. Next, case 2, write down HDPE granule. HDPE granules. HDPE granules. Now here the storage cost is given in rupees, and that too payable after 2 months. Storage cost is given 100 rupees per quintal. What is the meaning of quintal? Yes, 100 kg. What is the meaning of quintal? 100 kg. 100 kg. So one lot is 500 kg. So that means how many quintals are there in one lot of future? 5. So first I will multiply by 5 to find the storage cost of one lot. Find out the storage cost of one lot. Storage cost payable after 2 months, rupees 100 per quintal into 5 is rupees 500 per lot. Is rupees 500 per lot. Are you getting? Then write down step 2. Present value of storage cost. This is payable after 2 months. I have to add it to the spot price. Spot price and 2 months later figure can't be added in derivative chapter directly. In derivative chapter, time value of money is very, very important. So you have to take 500 upon e to the power RT. To compute future value, we have to divide by the factor e to the power RT. Take 500 divided by 2.7183 to the power 0.12 into 2 by 12. How much is that? I need an answer from you. Is the answer approximately 490.10? Say yes. Same strategy you follow. Okay. First, to simplify this power, and then use that 5 steps I have given in the previous example, which of course must have been taught to you in the SFM also. Now write down step 3, adjusted current spot price. Little fast, come on. Adjusted current spot price is equal to spot price plus PV of storage cost. Spot price plus PV of storage cost, which is 500 into 85 plus 490.10. One lot, after taking into account the storage cost, will cost you today 42990.10. And then step 4 will be theoretical forward price per lot. So we have to find out what will be its value after how many months? 3 months. So write down the formula: S adjusted into e to the power RT. S adjusted into e to the power RT equal to 42990.10. Take the previous answer into 2.7183 to the power 0.12 into 3 by 12. Just solve, then copy. So you don't have calculator, you borrow from, okay, and after the class you return it back, and 30 rupees is your lending charges later, not in advance, but deposit is 3 lakh rupees. Come to next point. So now tell me whether the future in the second case is overvalued or undervalued. You have calculated 44299. In the market it is 44500. Overvalued. Actual market value is more than the equilibrium value. So write down evaluation. Actual value of future is higher than fair value. Actual value of future is higher than the fair value. Therefore, future is overvalued. Therefore, future is overvalued. Bring calculator every day. I'm going to take questions tomorrow also. So what is the recommendation? In this example, sell future. Overvalued item sell. But in future market, only selling future is not enough. You have to create arbitrage profit such that afterwards you should not suffer the loss. So support it by buying spot. Buy spot return. Okay, one more practice, and then it is your good luck. Come to question number 2. ASF Limited trades in paper boards and manufactures carton boxes. Following information is available in the future market on paper board. So what are the two types of paper boards they have given? Single layer paper board, double layer paper board. Name does not matter in this case. Only understand the numbers. Current market price, spot price is given 500 per kg, 720 per kg. Carrying cost, underline, rupees per quintal per quarter. Rupees per quintal per quarter. And one more line, payable at the end of each quarter. So when are you going to pay the storage cost? after 3 months. Every 3 months you have to pay. And how much is that? 150 rupees and 200 rupees per quintal per quarter. Cash rebate for high volume purchases. I have added one more variable this time. The supplier will give you cash rebate given by selling company, underline receivable after 4 months. This will be received after a gap of 4 months. And how much is that? 10 and 15 rupees per kgs. And then this future contract will mature after 6 months. 6-month future contract rate. And very important, the lot size is 1 ton. What is ton? How many kgs in 1 ton? 10,000. 1,000. How many quintals in 1 ton? 10 quintals. In case of carrying cost, you multiply by 10 for one lot. In case of cash rebate, multiply by 1,000 to find out the cash rebate for one lot. So some GK is also tested. Okay. In certain batches, I have asked student what is 1 ton. He said 1 ton means 100 kgs. Risk-free interest rate is 9% per annum. Suggest the course of action to be undertaken by ASF. Now what you do, you will solve in the form of a table, okay? Because both questions are similar. Second column, only the figures are different. Steps are same. So heading, write down evaluation of future contract. Just write down evaluation of future contract. Don't write that word option. Evaluation of future contract. Written. Right hand side you draw two columns. SLPB, single layer paper board. DLPB, and you write serial number, particulars. Draw one full page. If you have a scale, draw the line. If you don't have scale, on your own, draw lines and keep some 2-inch margin in both the column. Okay, no scale, I can't lend you. I don't have scale this time. From tomorrow I'll bring for everybody calculator, scale, pen, pencil, huh? All, all commodities, yeah. But of course you have to pay some service charges for that without GST. Point number A, PV of storage cost. PV of storage cost. Now in this problem, be careful. You will incur storage cost 2 times. Sir, why 2 times? 6 months is the contract period. Storage cost is payable after every 3 months. So first you'll pay after 3 months, then you'll pay after 6 months. So right, PV of storage cost. There are two installment of storage cost. I have tried this question with the student in past batches. What the lazy student does, guess, he calculates once, multiplies by 2. Can we do that? No, you can't, because the timing is different. So you have to compute separately. First installment is payable at the end of quarter 1. Formula, write down storage cost, present value of storage cost equal to storage cost upon e to the power RT. So today you have to do some calculation. After many days, you are put to some work. So now see in your question, it is 150 rupees per quintal, but the lot is 1 ton. So the total storage cost of 1 ton will be 150 into 10 divided by 2.7183. R is 0.09. First installment is payable after 3 months, so we'll multiply by 3 by 12. Now it is up to you to solve this. Those who want to copy will wait 10 seconds. Any idea? Keep that factor with you, because that factor I will require in second column also. Is it right? That factor which you will calculate here, 1.0 something, you will use in the next column also. Just see the answer. Is it 1466.63? Right. What is the only difference in the next column and this column? Instead of 150, it is 200. So what you can do, if you have written that factor in your answer, this time you'll just type 2000 and divide by that factor. And if you have not written, there is one more shortcut. This is 150. This is 200. So again you divide by 150, remove the effect of 150 and multiply by 200. That is another way to do it proportionately. Okay. Do not reinvent the wheel again for the same thing. Second installment. Second installment, right? 1500 divided by 2.7183 to the power 0.09 into 6 by 12. Now here you write in bracket payable at the end of quarter 2. Do not multiply this answer by 2. Can you see these two figures are not equal? Just solve and see whether you are getting it. Around 1.1434 you are getting? 5. Why 5? Approximate. And again, if you have got this number, divide by 1500, multiply by 2000. You'll get this answer. Learn some basic arithmetic, okay? Done. Save time. Paper is lengthy. Actually not lengthy because you get 4 hours in this subject, okay? You can easily complete in 2.5 hours and come back home and study for the next paper. Point number B. PB of rebate cash inflow. PV of rebate cash inflow. When will you receive this rebate, in bracket, right? Receivable after 4 months. Now tell me, for single layer paper board, what is your rebate per ton? 10 into 1000. So write 10 into 1000 and calculation divide by 2.7183 to the power 0.09 into 4 by 12. Try to solve. Over. Anybody got the answer? 97? No, you don't answer. You are doing a lot of rounding off. This is a more accurate answer. 9704.40. Try the next one. Divide by 10,000, multiply by 15,000. Or you can just multiply by 1.5 also. Anji, what is your answer? 14556.60. Check. Are you getting? In the exam, mostly they will give you the factor. They'll give you the factor. So don't worry. So now we have got some basic working done. So what is the next thing we should do below? Guess. Adjusted spot price. In adjusted spot price, what I'll do, I'll take the spot price, add the two storage cost, less rebate. So that will give me the adjusted spot price after considering the storage cost and the rebate. and then you can multiply by e to the power rt, and that will give you the theoretical fair value of the future contract. Solve. Take calculator. First you tell me what is the price per kg. 500 into 1000. This is your basic price of that commodity, plus you will pay the storage cost. Add storage cost and minus the rebate. Minus the rebate. This will give you 493,196. Round off. This you can round off because this is a big number. If you want to write in points, you're welcome. Next is 720 into 1000 plus add the two storage costs that you have calculated as per your notebook. Minus that rebate. Are you getting 709311? Plus minus 1 rupee institute will accept, don't worry. Point D, write down theoretical forward price. Now this is the adjusted spot price. What will be its value after 6 months? I have to multiply by e to the power rt, which is nothing but future value factor of 1 rupee. Yes or no? Solve. Now good news, e to the power rt, here time is 6 months. While calculating storage cost, the second installment, already this factor you must have calculated. If you have written that factor, multiply this number with that 6-month factor, you can solve it fast. What is the second answer? Tell me. Anybody wants to volunteer? Is it 741 961? Now those who have done, write point E. Actual 6-month future contract rate. Actual 6-month future contract rate is 5,20,000. Is it given in the problem? 7,40,000. Is it given in the question? Say yes. Now write down point F, evaluation. Point F, evaluation. Evaluation, right? Actual future price, which is given in the question, is greater than TFP, theoretical future price. Is right? Theoretical future price. Therefore, future is overvalued. Therefore, future is overvalued. And in next column, actual future price 7,40,000 is less than theoretical future value. Therefore, future is undervalued. This was the reason for giving two products, so that you will be able to identify that what you will do with overvalued item and what you will do with the undervalued item. And point number G, write down recommendation. recommendation. Sell future, buy spot because future is overvalued. Last column, buy future, sell spot because future is undervalued. Done. Any query? This is how you will solve questions on this future pricing of a commodity future. Now we will take a break.